Hello and welcome to TK Services. So the first thing that I'm going to tell you today is the topic. This video is for the derivatives topic, which comes under the purview of strategic financial management. And I'm going to be talking about future contracts and basis risk. The intended audience for this particular video should be the CA final students who are studying strategic financial management and who ought to know about futures, and knowing basis risk will definitely give them a competitive edge. Over and above that, the CS final students and of course the CFA level 2 and level 3 students should definitely benefit from this video. Now let me come to the coverage for this particular video that I am making. I'm going to be talking about what is basis risk, how is basis risk created, and how does it impact the net gain or loss on the futures positions that you have taken. In this video, you will also learn how futures are traded and of course the relationship between both, that is the impact that basis risk can have on futures contracts. So now let's quickly come to an example which will actually tell you how basis risk works. Now if you look at the data that I am showing here, let me just expand this a little so that it's clear to you. There you go. Now if you look at this data, I have plotted the futures prices and the spot prices for delivery months 1, 2 and 3, and this is the prevailing spot price and the futures price. Two things you must note here. Number one, when we are talking about the spot price, we refer to the spot price of the underlying asset. When we are talking about the futures price, we are actually referring to the price of the futures contracts. So on one case, you have a position on the underlying asset. On the other hand, you also have a position on the futures contract, which of course covers the underlying. Keep in mind what these prices reflect and represent. Moving further, let's say today the spot price of the underlying asset is 400 and the futures contracts are trading at 450. Now, assuming that the futures contracts are overpriced and let's say the trader is expecting the futures contracts to decline in future, he will take an initial position of selling. So let me quickly note this down for you so that you don't forget, because this is going to be extremely important for the entire video. The initial position that the trader is going to take is going to be a sell position. He is going short on the futures. He is going short on the futures contracts. Now, let's say he takes an equivalent opposite position in the spot contract or in the spot market, and he takes a long position or a buy position in the spot market, and this one he's going long, therefore on the underlying asset, right? So essentially what he has done, he has bought this asset for 400 rupees in the market today, and he has entered into a futures contract to sell the futures at 450 upon the expiry of a predetermined specified period of time. Now let's say predetermined specified period of time is 3 months from now, that is the delivery month is in 3 months. Now what happens in case of futures contracts? If you notice here, the spot prices and the futures prices are same. If that is basically on the expiration of the contract, if you look at the prices here, the top one is the futures and this is the spot. And if you see here, the spot and the futures coincide here. And that is bound to happen, because if you were to settle the futures contract upon expiry, you should be able to sell at the same price at which the asset is being sold in the market. And if that does not happen, then it gives an opportunity to arbitrageurs to exploit the pricing inefficiencies. Therefore, it is bound that the spot prices and futures prices converge at expiry of the futures contract. Now, please note this down very, very carefully. Now, let's say we zoom directly to the third month after the trader has entered into the futures contract. Now please note these figures. His initial position was 450. He had sold the position at 450, and this the futures price in the third month is 410. Now let's say he does not want to go into for delivery of the asset. So what he is going to do, he is going to take an equivalent opposite trade to nullify the first trade. So what will happen? Let me plot this down for you. So if he takes an opposite trade, he is going to buy because his initial position was sell. So he will buy the futures, and when I say buy, he will spend. So I write minus 410, which is the prevailing futures price. So he's going to buy at 410 and sell at 450, which is the contracted futures price. With this, he can opt for cash settlement and close the futures trade. And his net gain on the futures is therefore 40. He has made a net gain of 40 rupees on the futures contract. Over and above that, if you look at this, the fact that this is just on the day of expiry or maybe a little time before, the spot prices and futures prices are the same. So the asset which he had actually bought, if you look here, he had taken a long position on the underlying asset. So the asset which he had actually bought for 400, he can now sell in the market for 410, and therefore he can actually make a gain on the asset of 10. So I'm going to put this here. The gain on the asset is 10. So what is the total gain that this trader has made? The total gain that this trader has made is 50. This is the gain that the trader has made on the futures contract if he has waited until the expiry of the contract. Whether he takes delivery or not, it doesn't make a difference to the trade. It is just the modus. The value of the gain will remain at 50 rupees as I just displayed to you. Now this is how a futures contract works, and on expiry you have noticed that he has actually made a gain of 50. Now let's say I plot the basis, and for understanding I am telling you that the basis is actually the futures price minus the spot price. So the initial basis was 50, and if you look at the expiry, the basis will come to 0 because I told you it is bound to happen that the spot price and the futures price is going to be the same. So there is obviously going to be no basis at expiry of the futures contract. Now if you look at the, let us try to interpret this data. If you interpret this data, if you look here, he has actually made a gain of 450. Sorry, he has made a gain of 50, right? And the basis was also 50, right? Now, let us also try to understand what is the change in the basis by looking at the graph. When he started the contract, his basis was 50. At expiry, the basis is 0. So the basis has actually changed by 50, and that is the gain that he has made on the expiry. This is not a coincidence, mind you. You will see that in all the months. The other thing that you must notice is how much is his net realization. If we look at it in the other way, it should not give you different results. Now his net realization is nothing but he is going to get the futures price plus he will sell the asset in the market at 410, and he will close out the futures trade at 410. Therefore his net realization is 450. The cost of the asset was 400, and therefore his net gain is 50. Okay, mind you, this actually should be here because we are talking about the third month, so I'll just put it in the right space. Yeah, so if you see here, the net gain is 50. Now this is one way of deriving his net gain. This is the other way of deriving the net gain. I'm just telling you two different perspectives so that you exactly get a clear picture in your mind as to how futures contracts trade. Let me go back to the Excel file. Now let us go to month 1. Now let's say the trader does not wait until month 3. He wants to nullify the trade in month 1 itself. He wants to settle the futures contract. To settle the futures contract, he has to take an opposite trade. His initial position, ladies and gentlemen, was a sell position. So now he has to take a buy on the futures. When he has to take a buy on the futures, he will take a buy at 440 and sell at 450. So if I were to take this again, yeah. So now he will be buying at 440. So I illustrate that by minus, and he will be selling at 450, the contracted futures price, thereby making a gain on the asset on the futures by 10 rupees. Over and above that, if you look at the Excel file, the month 1 spot price is 402, which means on the underlying asset he has also made a gain of 2, which is nothing but 402, which he realizes by selling the asset in the spot market at time t, minus 400, his spot price at time 0. So his gain on the asset is 2. So his total gain is 12. Please keep this number in your mind. His total gain is 12. Now let's go back to the Excel file. And now do you see, let's compute the basis over here. So the basis is actually 38. Now if you look at the basis, it's again futures price minus spot price, which comes to 38. Now if you go to the graph, you will see that the initial basis at time 0 was 50, but at time 1 this has shrunk, or the basis has weakened to 38. Since the basis has weakened, the change in the basis is 12, and that, friends, is the gain that he has made on the contract, which is 12. The other way to get this gain is obviously like this. So he has actually sold the futures at 450, plus he is being able to sell the asset at 402, minus the futures price at time period t, which is 440, which is 412. His net realization is 412. The cost of the asset remains at 400, and therefore his net gain is 12. So again, you see here that the net gain is exactly equal to the net gain which we compute by this method. Again, different perspectives, but the same concept, and essentially you are arriving at the same number. So they're just different ways of looking at the same thing. Now let's say we move to the, let's say if he doesn't terminate the contract at month 1, if he terminates the contract at month 2. Now let's compute the basis. So if you look at the basis here, the basis is actually 15, which is 420 futures price minus the spot price at time t. 420 minus 405 is 15, right? Now, if he were to execute the contract on this day, again, his initial position was sell, so he'll take an opposite position, which is buy. So he will buy at 420 and sell at the contracted price of 450. So he will buy at 420. So when I say buy, he has to, I'm putting this down as minus. So he buys 420, opposite trade, and original trade was selling futures at 450. So his net gain on the futures is 30. Plus, mind you, ladies and gentlemen, on month 2, the asset which he has bought at 400, he is now able to sell in the spot market at the end of month 2 at 405, which means he also makes a gain of 5 on the asset, on the underlying asset, which I denote here. So the gain on the underlying asset is 5. Now if you look at his total gain, the total gain comes to 35 rupees that he has made on the contract, right? Now let's go back to the graph. Now his initial basis when he started the contract was 50, and at month 2 his basis we saw has shrunk to 15. So from 50 it has come down to 15, which means the change in the basis is 35, and that is exactly equal to the net gain he has made, as we can look here. Again, we have proved the same concept. If you look at it from a realization perspective, he has realized 450 on the futures contract, 405 by selling the asset in the spot market, and 420 for nullifying the futures contract. So he actually has a net realization of 435. Now his spot price of the asset does not change, which remains at 400, and therefore the net gain is 35. And this is the same net gain that you have computed here. Now going back to the Excel file, let us quickly again see. The initial basis was 50. If he terminates the contract at month 1, the basis is now 38. So the change in the basis is 12, and that is his net gain, 12. If he terminates the contract at month 2, the change in the basis, it was 50 earlier, 15 now. Change in the basis is 35. That's his net gain now. If we move to month 3, there is no basis. So the change in the basis is actually 50, which gives him his anticipated net gain of 50. So the change in the basis is what is getting the gain for that particular trader. Now, what is basis risk therefore? Now, if you look at this realization, that will tell you what is the basis risk. At any point in time, the realization is basically equal to the contracted futures price at initiation plus the spot price of the asset at time period T minus the futures price of the asset at time period T. Now, depending upon the movement of the spot and the future prices is what will bring about his net gain. Okay, so that is absolutely clear. So which means if we were to put this down in terms of a formula, let me just put this down for you. The realization is actually the futures price at initiation plus the spot price at the time period T minus the futures price at time period T. If you look at the Excel file, this is exactly how we have computed the net realization. So now what happened in case of the first month? In case of the first month, the difference between the spot and the futures was 38. 402 minus 40, which means you are actually subtracting 38 from your initial locking price. If you look at the month 2, spot minus futures is 15 minus 15. So you are actually subtracting 15 from your initial futures price. In the month 3, there is no gap between the spot and the futures, which means as you're moving across the months, in the first month when the gap was large, a larger gap reduced from your initial futures price to give you a lower net gain. In the subsequent month, there was a weakening of the basis, and therefore you reduce a lower amount from your initial contracted price to give you the net realization, and you had a higher net gain. And that, my dear friends, will actually tell you how basis risk works. So if there is a gap between the spot price and the futures price, the larger is this gap. Okay, the larger is this gap, the more is the reduction from the lock-in price, lesser is the realization, lesser is the net gain. Which means what? Now you will normally have, and if this gap reduces, let's say this gap reduces, so the difference which actually exists between, which is what you saw as we move towards expiry. As you move towards expiry, the gap ideally between the spot price and the futures price comes down, and therefore this particular subtraction or reduction from the lock-in price or the futures price minimizes and you maximize your net realization and therefore maximize your net gain. So this movement or this difference between the spot and the future prices, which I have denoted here, of course I have denoted it as a difference between the futures prices and the spot prices. This difference is called as the basis risk. And this is how the basis risk impacts the future contracts. So if he was looking at a net profit of 50 to start with, he is now looking at a net gain of 12, which has happened because of the weakening of the basis. Mind you, if the basis strengthens, then what happens? If the basis strengthens, you're looking at a higher futures price and probably a lower spot, which means you're going to have a loss on the futures contract or a minimal gain on the futures contract and probably a loss on the spot contract as well. Which means as the basis strengthens, he is definitely going to probably move towards a loss scenario. Mind you, the definition of basis and its correspondence with what position he has taken initially has to be kept in mind. If this gets reversed, the scenarios may get reversed also, if you understand what I mean. So this, my dear friends, was just a quick example of what is basis. So basis is nothing but your futures price minus the spot price. What is the net gain on any basis contract? And most importantly, also, how is the net gain computed by two different methods, which I told you? And most importantly, to be able to collaborate that or to be able to link that with the graph and how you can arrive at the same figures with two different perspectives, right? So this was the learning that you had in this particular video. Remember, the basis risk basically, now you don't know, in an ideal situation you will expect, now what, let me give you another glimpse into the basis risk. In the ideal situation, you will expect that the futures and the spot price will converge at expiry. What if you don't? Now you don't know what will happen on that date. If it doesn't happen, you don't know what is going to be the spot, what is going to be the futures. Now depending upon the spread, which is the between the spot price and the future price, your realization could either move upward or your realization could move downward, and therefore your net gain position might change. Same is if you want to close out the contract prior to the expiry period. So that risk, which is the difference between the futures and the spot prices, is called as the basis risk, and this is how it affects futures contracts. I hope you enjoyed learning this particular small example or video which I prepared on basis risk on the functioning of the futures contracts. Thank you very much.